Okay, good morning or good afternoon, depending on where you are. Welcome to the FX Street webinar. My name's Ian Coleman. I'm one of the partners, traders, analysts at Pia First. We produce technical reports, trade recommendations on a variety of products, obviously including FX, stock indices, fixed income and commodities. In foreign exchange or in any sort of trading, we're always looking for a bias. Okay, we're looking for price action that highlights a continuation of trend or a reversal of trend or a correction or consolidation. Okay, and they're probably the four patterns of trading, if you like, that we're looking at. And basically what we like to do is we like to look at vanilla charts, which are basically plain charts. There's very little in the way of indicators apart from an Ishimoku cloud, and we look at these chart formations or these chart patterns to try and get a bias for the day, week, months ahead. We then overlay our grey box system onto these charts to highlight clear areas of support and resistance. Today we're going to obviously break down what we do every week, which is we try and get a bias from the dollar index first, and then we break down the currency pairs. This week we're also going to look at stock indices, where we think they're going to be going in the near future. And we're also going to talk. We like to sort of overlay the presentations with obviously some educational input too. So we're going to talk about Fibonacci confluence areas. These shouldn't be mistaken for symmetrical patterns, okay, which are a whole different ball game. And we're also going to talk about price and time. Now, a lot of analysts, chartists will highlight areas of support and resistance as we do. But when you actually look back at the people or the analysts or the people that have developed trading systems, Gann theory, Elliott wave theory, and more recently, I suppose, Martin Armstrong, they don't just talk about price, they also talk about time. And I think that that's a very important factor when you look at analysing and especially forecasting your projected targets. The reason that we like to use time as well as price is because I'm also quite fanatical about DMARC. Okay, DMARC is an array of indicators. The basic DMARC indicators is called the DMARC or the TD sequential. And basically what that highlights is not only projections, corrections, exhaustions, but also possible changes of trend. Okay, he's got something that he calls a TD flip, which basically says, well, the market has moved from bearish in that time frame to bullish, and then we can get these correction counts. So I'll try and show some of the DMARC charts a little bit later on, but I will discuss what the DMARC counts are in the dollar, in the dollar, and also these different currency pairs as we go through. Basically, if you're in a bullish DMARC count on the 6 hour, it runs to 9. So if it starts at 1, you've obviously got then 8 6-hour periods to get to the 9 candle, which highlights a correction. Obviously, if you get a 1 count in the 60-minute chart, then you've only got 8 hours of bullish price action. So it is quite important. And the reason, I suppose, why I'm highlighting this today is because we have had quite a decent breakout in the dollar index and DMARC is still highlighting a bullish count. So even though we've seen a small correction today, I think it's going to be very short-lived, and we're going to end up breaking to the upside. So first of all, we're going to talk about the dollar index. Now, last week we highlighted the head and shoulders formation. So last Monday we were sat here at exactly the same time saying this is what we think is going to happen in the dollar. There was various reasons. We had a correction count on the 6-hour chart. Okay, and we actually posted an outside bullish count just here on the 15th. Okay, so this rundown produced a 9 count on a DMARC. We then got an outside bar. We then rallied up. This was our neckline, and then we broke the neckline. We also post some reports on the Saxo trading floor, and on Thursday morning of last week, we highlighted, or I highlighted, a report of why the euro, or why the charts dictated that the euro should collapse. And obviously, we used some cross currencies there. We didn't just use the euro against the dollar. We highlighted euro sterling. We also highlighted euro yen. And obviously, that's a bit of a history lesson, but that was just purely on chart formations and getting a bias of where these currency pairs should go. So we've had this strong run up. We, in one day, quite easily surpassed the head and shoulders target. We've also, which was 96.20, as I'm just highlighting on the screen, we also clearly broke a 261.8% extension level. We really have to break it down to the daily chart to see where we are now. And we're just, let's just get rid of this, and we're just at the top of this this daily channel formation. So there's no clear indication of a change of trend. Every time frame is in a bullish count. There's no reversal candles from the top. 6-hour chart posted a very small doji, but we see that as being pretty irrelevant. What we talk about sometimes as well, especially between ourselves, me and my colleagues in the morning, will say to us, right, what's going on today? You've got to be aware of your surroundings. And we'll have a look at the economic calendar. And the economic calendar, obviously overnight and today, is highlighting very little in the way of economic releases. So there's a good chance today that we'll end up posting inside candle on the dollar index on the daily chart at this trend of lower highs. And as you can see, we're just holding in the upper half. So the Marabuzo level actually from Friday is holding back bears at the moment. And we're probably going to close around these levels, to be perfectly honest, with the lack of economic data that's going to be released today. So likely to get an inside bar. Dips, we're looking to attract buyers now. There's two relevant support levels today. If we're going to get down there, 96.81 is the next support level, and then if we would break there, which I very much doubt, then 96.47 is a reverse trendline support. But as I said, the bias in the dollar index is still strongly bullish. There's no clear indication of a change of trend. Remember what we were talking about before. We're talking about getting a bias. Half the battle in trading is trying to get a bias. Okay, so what is the bias? The bias is to the upside to a certain level. Then we would probably look for a correction to a certain level, and then of course the bias then returns to the upside. So this looks like consolidation. Out of our four formats, our continuation, our reversal, our correction, and our consolidation, this is likely to be a consolidation day. Okay, price and time still indicate that we should be bullish in the dollar. Has anybody got any questions about the dollar index before we start moving over to the main currency pairs? Nope. Okay. So euro dollar, again, this was sort of the reverse pattern. I've not updated these charts from last week, but that was the head and shoulders pattern that we highlighted. We obviously had an aggressive move to the downside. Now, we also like to break down time frames, which we mentioned before, moving all the way out to monthly charts or weekly charts, okay, and then breaking back into shorter time frames to try and get our trigger levels, support and resistance levels, and realistic entries. Okay, you know, anybody could trade off. What I should say is all candle formations are the same, no matter what time frame they are. The higher the time frame, the more relevant they are. Okay, so if you get an acute monthly reversal candle, which is an AMR, on euro dollar, then it's far more relevant than a reversal candle on a 5 or 10 minute chart. Okay, you've then got your medium term bias, and then you can work back, okay, and then break down time frames. And just to give you an indication of what acute monthly reversal candles are, here's one here, which is a bearish outside monthly candle. Again here, bearish outside monthly candle. Again here, bearish outside monthly candle. Okay, here's a bearish outside monthly candle. Didn't really work, but you've had 3 out of 4 that did. Obviously a doji bottom, morning star formation, again an acute monthly reversal candle formation that moved to the upside. So these give us our bias, and then we break down into shorter time frames. So here, what have we got on the monthly? We're 26th now. We've reversed all the monthly gains. We're likely to get an outside bearish candle. Last month, all we highlighted was indecision. Okay, and then we're moving to the downside. Our medium-term target level is parity for euro dollar. There is no clear indication on the monthly chart or on shorter chart time frame charts that anything else is really likely. Obviously, we've got to get that clear dollar breakout, but there's other reasons why euro dollar is still bearish. If we go down to the daily chart, okay, we've broken out of a channel formation to the downside, and again, look at the reversal candles. We've got a bearish outside bar here. We've got a bearish outside bar here. These are clear indications of changes of trend. Okay, so going back to our format again, reversal, correction, continuation, consolidation. We're looking at reversals here, and we're looking now at an impulse move to the downside. It's always hard to get on a trend when the trend has started, because we're always wary of how far the trend is going to continue. And again, talking a bit about DMARC, this is why I particularly like to use DMARC in all my analysis, because if I'm in the shorter end of a count, in other words, if I'm in a bearish count and I'm only in maybe a 2 or 3 hour candle, sorry, a 2 or 3 bearish count candle on the 2 hour chart, that means I've got another 6 hours, or 6 times 2, which is 12 hours of downside pressure, potential downside pressure. And that again is why it's not just about price, but it's also about time. So we've broken out of this formation to the downside. We've had a retest this morning of the channel breakout. If we actually break it down to a 2 hour chart, and this is just how we read the charts. Okay, they're basically like a book. We've got to try and read them, work out where our bias is. And here we've got a bearish outside bar again, and the last 2 hours gains are again being rejected. There's only one slight hiccup in the ointment, if you like. and that's that we hit a 261.8% extension level. But the scope of the downward move and how aggressive this downward move has been, I would very much doubt if we at least breach this area. I think even small intraday rallies are going to get sold into as we hold outside this this daily channel formation, and also using correlation. Okay, if we look to euro sterling, that is still bearish, and we'll cover that in a minute. If we look to euro yen, that's in a bearish channel formation. So using correlation as well, the euro crosses highlight that we shouldn't be buying euro. Obviously, we should be still looking to the downside. If we want to buy other crosses or other dollar-based currency pairs, so in other words, if you want to be selling the dollar and buying sterling dollar, look to those other currency pairs. Do not look to euro dollar, because euro dollar is likely to be the force that's going to move this dollar index aggressively lower. And we're just going to put a fib extension on here, because we do like to look at Elliott wave again to a certain extent, not too aggressively. The next sort of real area of support is obviously here, lining up the 150, probably going to spike through to 106.94, which is 161.8% extension level before a little bounce. Do you remember we said about our area being around parity? It's actually 1,000 or 1.0080 to just under parity is the confluence area on that monthly chart. If we take a 261.8% extension level from this last swing, then price action dictates that we should get down to 1.0066. Okay, so again, hunting that parity level. And those who like Elliott wave, we've obviously got one. Then the move up. Sorry, I'm not going to do all the waves. Move up in 2, move down in 3, small bounce in 4, and then down to complete the medium-term projection around that level. We could well bounce from parity, by the way, and move all the way back to this level, and until sort of a medium-term, possibly a medium-term reverse head and shoulders formation is posted, the bias has got to be down, got to be lower for this pair. If you're struggling to get in, if you risk reward, or if you only like to sort of work with 30-40 pip stops, just trade in smaller amounts. Okay, try and get into these trades to bleed these long-term moves, because it's the long-term moves that really line the pocket, not the short-term moves. If you can get into one of these trades, again, there's different ways of doing it. You can either trade in 2 units, take 1 unit off when you get to a decent support level, maybe this 127.2 extension, take half off, stop to entry, and then try and bleed your balance all the way down to around parity. Or you do the opposite. You trade in small, you sell half a unit around current levels, and then as long as it doesn't sort of breach a significant high, which is a 111.50, you can then add in a slightly higher level to improve your average to the downside. Again, money management, one of the most important factors as far as trading is concerned. So our bias for euro dollar still to the downside. We've had a breakout. The weekly chart highlights an evening star formation. We've broken out of a channel formation to the downside. Monthly chart confluence area, Fibonacci confluence area, highlights that we should be moving towards parity. The dollar highlights that we should be looking to sell euro dollar and not buy it. So this week and the weeks ahead, that's what we'll be doing. We'll be selling breaks or selling into rallies. Any question about euro dollar? Might struggle to get through everything here actually, so we'll just speed it up a little bit. No, all good. Okay. So cable, slightly different picture in that we're in a corrective channel formation. The base of this formation will probably line up when euro dollar hits the base or gets to around parity. So this move to the downside is probably going to be a lot more choppy, a lot more volatile than the euro dollar sell-off. And the reason I'm saying that is that obviously we're talking about correlation. Euro sterling still has ample scope to move lower and more aggressively and more and quicker than well, euro dollar should move a lot lower, a lot quicker than sterling dollar using that euro sterling correlation. Breaking it down into shorter time frames. I'm just looking at the screen at the moment. When is the rally over? Which rally? The dollar rally or the indices? When's the rally over in euro dollar? I'm not quite sure which rally you're talking about. I think the rally is probably over. If you're talking about euro dollar, I think it's not a rally, is what we must first highlight. You know, what we were talking about earlier, continuation, reversal, correction, consolidation. A continuation is a rally. This move higher in euro dollar is a correction. I think the correction is probably over and done with already, to be honest. But like I was saying, it's close to a 261.8% extension level. You don't really want to necessarily be selling into the base. So if you were to sell at the moment, you just sell in half size, so that you've still got the ability to sell into this correction if it moves slightly higher. I hope that answered your question. I was a bit not quite 100% clear on what the question was, to be honest. So cable again. Where's the dominating candle? Well, the dominating candle here is this outside bar. Okay, so obviously large rejection of gains on Thursday, then a continuation. The reason why we're stalling today, just get rid of this one. And this is just, again, just very plain vanilla charts, okay, is because we're just close to this trend of higher lows. What do we see here? There's certain formations that are easy to trade. There's other formations that are extremely hard to trade. One thing we have here is an impulse move to the downside. We then have a choppy wave price action to the upside. If we put a fib on here, okay, then it's stalled between 61.8% and 78.6%. But more importantly, I think we discussed this last week, is this currency pair is in an expanding wedge formation. An expanding wedge formation is the hardest formation to trade. If you think about a consolidating or an ending wedge formation, price action gets wound up within the wedge, and then we get the impulse breakout, hopefully to the downside, obviously on an ascending wedge formation, target being the start of the wedge. On an expanding wedge formation, the opposite applies. Price action can get wider and wider and wider, and hence your stops are wider and wider and wider because we keep on expanding to the upside, and it's only on a break of the lower trend line that the bias then becomes strongly bearish, and then we target this level. With regards to sort of intraday bias, it's pretty mixed at current levels. 153.62 to 153.72 is a pretty strong intraday resistance level that that we'd expect to hold. Again, the bias, because of that daily chart, because of that daily candle, it's given us a count as well to the downside, a bearish count. So our bias is still to the downside. So we still want to be selling in rallies, but again, we want to be looking for prime areas of resistance. At the moment, sort of intraday dips are being bought into. You've got to remember that dollar's still correcting off that channel formation to the downside. That means these intraday dips in sterling dollar are just being bought into at the moment. But we expect that to be short-lived. And like I said, 153.62, 72 is a pretty solid area of resistance. At the moment, we're still holding on to Friday's Marubozu level, but we could well breach that, to be honest. I think that's at 46, 47 area. So again, the bias is to the downside in cable, but you really need to see, we need to see, I should say, a break of this this trend line at 153, the figure. And then we should get an impulse move to the downside. Again, we were talking earlier on about knowing your surroundings, what data's due to be released. Is it likely to move markets? Yes, no. Which way is our bias? Do we want to get in before the figures, or would we prefer to sell the break over the figures, or buy the break over the figures? Tomorrow is obviously big figures out of the UK. It's the GDP figures at 9:30. So again, talking about what we're looking at, excuse me, a quick drink of water. Talking about what we were highlighting in the dollar index, likely to post an inside bar today. So price action is probably going to be lackluster today, and then would look for a break to the downside tomorrow. But again, 62.72, if we get to those levels today, they're good areas to short with sort of 30 pip stops, and then targeting these lower levels in the coming days. Okay, dollar Swiss. A harder currency pair to trade. Used to be really easy. Used to have -1 correlation with euro dollar, obviously when euro Swiss was pegged. Now that's not the case. We have moved to the upside, and I'm not going to spend too much time on dollar Swiss at the moment because I haven't really got a strong bias on it. We have moved to the upside today. We have broken out of this triangle formation to the upside. The medium-term bias is bullish. We had an outside bar here again at the low, which sent this currency pair pretty aggressively higher. My preferred trade would be to buy on dips at the moment, only because the 1 hour time frame is highlighting an exhaustion count on the DMARC, so 13 exhaustion count, and intraday signals for sentiment are pretty overbought. So it's a mixed bag, and dips are likely to be limited. But at the moment, I prefer to buy dips around this sort of 97.10 area or 20 area than to be sort of buying into the highs. Dollar yen, Bill and Ben. Monthly. Possible head and shoulders. You can't call a head and shoulders yet. It's got miles to move to the downside if it does move to the downside. it's consolidating. We did have a bearish outside bar, but it wasn't posted from the high. We then had consolidation, or we've had 2 months worth of consolidation. Bias is mildly bearish at the moment, but that's after further move to the upside. I'm just going to clear these because that was again, so I can highlight what we're thinking at the moment with regards to dollar yen. So we're just going to put a channel formation on. If you notice here, okay, this high and this high lines up nicely with these two low. So we've sort of got a symmetrical channel, if you like. And then we've broken to the upside. Now, come on. This was something that we highlighted last week, which was the channel formation. We've recommended a buy trade for our direct customers this morning. I believe it was at the 80 level. Just trying to get my charts working on the next screen. So basically, what happened this morning, or the reason that we posted a trade recommendation buy this morning, is because we have a continuation candle in this channel. So the channel, we've got one of these bullish outside bars, but it's in the middle of a trend. Now, again, it's not as strong as a bullish outside bar at the base of a trend, or a bearish outside bar at the top of a trend. But if you look here, we'd already posted a morning star formation. We then posted this continuation pattern. So this is the reversal down here. This is the continuation pattern. This is the channel breakout. What we had this morning was we had our bespoke support coming in at 120.78, and then we had this reverse trend line at 120.72. We recommended a buy at 120.80. It's still holding. I think what we're going to get in dollar yen, and the reason why I've highlighted this is obviously it's a channel top, and it's a potential right shoulder in a bearish head and shoulders formation. Potential, and notice I say potential. It's there's other formations here that would highlight we're going to continue to the upside, not to the downside. And again, it looks drastic there. If we pull it in, it doesn't look as drastic, but it's an expanding wedge formation. An expanding wedge formation has an eventual bias to break to the upside. I would expect price action to remain pretty mixed and volatile in dollar yen while we stay inside this pattern. Okay, an ABCD formation. So there are barriers to the upside. The thing is, we've had, I think it must be nearly 40 days now of inside bars. So all of these candle formations, choppy, mixed, volatile, are all inside this bearish day from the 24th of August. If and when we break the high of that candle, we're likely to have an impulse move because there's likely to be numerous stops placed above that candle high. So obviously here, let's just highlight what it is. Here's a decent barrier, 122.50, and then 123.62. At the moment, and obviously depending on price action, I would not expect much of a move above this level, this 123.64 level. We are in a longer time frame bullish count at the moment. So the daily chart is highlighting a bullish count. We are probably going to continue that bullish count until the end of the week. We've got another 4 days until we get a correction count. So again, plenty of scope for dollar yen to move to the upside. Any questions about that pair? No? Okay. Aussie dollar. Aussie dollar hit this medium term trend line, broke through it, it's now moved back above it. Going breaking down into shorter time frames. This is only weekly, so in shorter time frames. There's no clear indication of a change of trend. Daily chart. Again, that's where we obviously talked about the wedge formation last week. Daily chart. Again, no clear indication of a change of trend. However, again, using correlation, if these stock markets are going to move higher on potential increase in QE, etc., then Aussie yen being the main currency pair for the carry trade still, this pair could consolidate or just move higher as euro dollar moves lower. So again, if you're looking to play the dollar bull move, Aussie dollar is not your currency pair. You should steer well clear of Aussie dollar. Rumours in the moment that we might get a rate cut, I don't think so. I think we stay in this expanding wedge formation for some time yet, and we'll probably move up to test the upper trend line before we eventually break to the downside. And again, there's no clear reversal candles. We could break to the downside and then form a reverse head and shoulders formation. Far too early to tell. 4-hour chart, we're in a channel formation. There's scope for a move in either direction. Let's get rid of that. At the moment, our bias is to sell into rallies close to the top of the channel formation, which is 73.11. The corrective move to the downside doesn't look like it's finished yet. Also, DMARC is highlighting a. Why can't I see the bottom of the chat? Sorry. Jesus, sorry. How do you take into account the dollar index chart when considering Aussie dollar, dollar yen? Not with as much of a bias is the quick and easy answer, I suppose. The dollar index is obviously made up of all the dollar denominated crosses, with euro dollar taking the majority of the basket. Again, you have to use correlation and not just go purely dollar. You have to obviously, for euro dollar, sterling dollar, then we look to euro sterling. To Aussie dollar, we also look to stocks, shares, gold, commodities. For dollar CAD, we obviously look to the dollar, but then we look to oil. Dollar Swiss, again, we look to euro Swiss safe haven. So it gives us part of our bias. It doesn't give us our bias. If we get the dollar index correct, then that's half the battle. We then need to look at correlation again with regards to other currency pairs, cross currencies, etc., to highlight which of the dollar pairs or dollar denominated pairs are the best ones to trade. Yeah, it's a good question. We have a bias, but it doesn't mean that that's all we trade. Obviously some days we can be selling euro dollar, we can be buying Aussie dollar. Obviously the trade of the day then really would be to sell euro Aussie, but it's not one of the currency pairs that we regularly forecast on. So Aussie dollar, as I said, in an expanding wedge formation on the daily chart. 4-hour chart is in a channel. It is a bullish channel, but the scope for, it's a bullish channel, but it's 105 60 odd pip range. So there's scope for a move in either direction. Really, if you want to play it, if you want to play the range, then you've got to break it down into even shorter time frames. Look for reversal or continuation patterns to take you or move you away from the top of this channel or the base. But again, because we've got that firmer outlook in stocks, and we've still got a firm outlook in the dollar index, Aussie dollar, mild bearish bias at the moment, and that's about as aggressive as we can be. Dollar CAD, and I think commodities is probably going to consolidate as well for some time. Now, dollar CAD, one of my favourite currency pairs. Monthly, it was virtually pit perfect on the 61.8% Fibonacci level. We then had quite a decent sell-off to the downside. If we broke it down onto the weekly chart, okay, we had this bearish outside bar that pushed us lower. Now, I think is the next drive to the upside, but trend of higher lows held. I don't think it's going to be extensive, the move to the upside. I think we're in an ending wedge formation. Again, the dominating candle or continuation candle is here from Friday. We've had a mild dip to the upside, so the top of the Ishimoku cloud is holding at the moment. However, let's just get rid of this. This was a wedge breakout. It was a head and shoulders formation. It was the end. Well, let's break it all the way down. So that gives us our bias. Medium term, long term, we've got to be bears, but there's ample scope for a move higher in that wedge formation before that. Here, we're virtually pit perfect actually on the 260 on my charts anyway, on a 261.8% extension level. We've then highlighted a head and shoulders formation. Okay, so this is our head, left shoulder, right shoulder, broke to the upside, moving higher, not near the target level yet, came back, nearly had a retest. Target levels 132.63. This move lower this morning is a flag pennant formation. Again, is seen from 161.8%. So using our bias, there's no clear indication that the dollar CAD is reversing, moving to the downside. We've got our support at 131.27 and 131.10, looking to fade a move basically down to those levels with a stop underneath 131 today for a drive higher. First target area is going to be here, 132.60, and then potentially a move to the upside. Now, we again go back to this channel top, we could see 135 or beyond. You've got to remember that commodity pairs can quite easily break through the 261.8% extension level. People used to say that smart money trade commodities, and that's why the commodity-based currencies are normally the first to move and will move faster and further than other major currency pairs. Don't know if I believe that or not, really. The only thing that puts a small dampener to make sure there's no more questions. The only thing that puts a small dampener on this outlook and that's why it is a cautious approach at the moment. Easy for you to say. Is again possible expanding wedge formation that has an eventual bias to break to the downside. But we talk about impulse and corrective moves. Okay, this is impulsive, this is corrective, this is impulsive, this is corrective, this is impulsive, this is corrective. So we should get at least one more impulsive move to the upside before a possible reversal. So at the moment, like I said, still buying dips in dollar CAD. What's the time? Right, should we talk about the DAX or should we talk about Euro Sterling? Anybody got a preference? No preference or no interest. Okay. DAX. Okay. Outside bar moves to the downside. We haven't had a reversal formation. However, we're trading to the highest level in 9 weeks. The last 2 days of price action's been pretty aggressive. One thing I should also say is that a lot of traders, analysts, are always looking for points of reversal. So that's a good area for a reversal. It's a trend line. It's 261.8% extension. It's etc. 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 There, you should also look with the same passion, if you like, for those to be target levels. I don't know why, but our brain is geared to try and pick the top, pick the bottom. Don't try and pull away from that. Try and turn around and say, well, if it gets there, that's a good target level because of. If it reverses there, well and good. But you should be riding it up to that target level, not necessarily trying to reverse a very bull market at that target level. So here, we're in, and I'm not going to highlight all the other cross currencies. Sorry, the other indices. They're all pretty similar apart from FTSE. We're in an expanding wedge formation, mixed volatile price action while we're in this pattern. The bull market, as far as I'm concerned, hasn't finished. This highlights, indicates that we should get a breakout to the top side and we should rally to multi-year highs again. Talking about the confluence area again, which we were highlighting earlier on, or we said we'd discuss earlier on. We got a 61.8% extension level coming in here, but I think this is far more important. Okay, this is the 78.6% reversal fib, and if we just drop some of these off, so we can see a bit clearer. Use an extension tool. Okay, it's also a 161.8% extension. It's near the breakout level. So I think intraday dips, we tried to buy this morning. Our trigger level was 55, I believe, and it made a 58 low. Got to be buying dips. There is no clear indication of a change of trend. What I think will happen is we'll break out of this trend of lower highs. We'll then pause at the 161.8%, move back to maybe retest or even further, and then have the next impulse move to the upside. 12,475 is the 261.8% extension. The previous high is 12,403. So again, technically, can see no reason why we're not going to get a sort of decent stock market rally, a continuation, especially with the chance of more QE. Let's break this into euro sterling. We've got time. Just have a look, see if we have a chat. I haven't been told that we're. I'll just do it off one chart. The bias is bullish, but not yet. Okay, this is a large corrective channel formation. We are going to post an outside monthly candle, but sorry, forgot to do it off the same chart. This looks like a head and shoulders formation, or a reverse head and shoulders formation, with ample scope to move to the downside yet. Okay, so this is our potential head, and at the moment this is only a potential head and shoulders formation. It's not formatted. In fact, if you're the actual proper way, if you like, to trade these formations is trade the breakouts. We don't. We try and trade right shoulders, necklines. As long as we've got counts, as long as we've got reversal formations, then we're quite happy to call the trades at these support and resistance levels. Now, daily. This could be seen as a very rough 5-wave pattern to the upside. 1, 2, 3, 4, 5. This is an impulse move, if you like, to the downside. Now this candle here, although it was breached, this candle here is a bearish outside continuation candle. It highlighted the start of a DMARC bear count. If we break it down, and it's not finished yet, that's what I should say. Today and tomorrow, rallies should be sold into. I am short euro sterling. 4-hour chart is posting a bearish outside bar with a bearish count. There's a head and shoulders formation. Sorry, people clicking on the wrong bloody chart. Let's just get this to 2 hours. So get the projection. This is consolidation. Again, head and shoulders formation, which we highlighted last Thursday. Okay, nowhere near target level. So 71.20 is the head and shoulders breakout level. I think the reason we might be consolidating at the moment is just because this looks like sort of target area for an ABCD formation, but there's no clear indication. This is what I have to say, because it's all well and good. It's like people look for ABCD formations and then think, well, that trend's over, so we're going to just take it higher. There is no clear indication of a change of trend. If you were to put any sort of moving averages on this chart, they would all point to the downside. Your hourly chart might be sideways. Rallies bought into. You've had a little bounce on Friday off the bottom of a Ishimoku cloud formation, but if it breaks Friday's high, then that is a proper, the Zen lines are in order. It's a proper breakout to the downside. There's no real reason to be buying euro sterling as yet. So selling rallies, selling mild rallies, selling breaks is the way forward. 71.19, so 71.20 is the target level for the head and shoulders breakout. I think we'll go further. Like I said, I think we'll move down towards this this channel base, which is coming in around 70.25, before we see any sort of reversal, consolidation, potential move back to the upside. So just to reiterate what we've talked about today, the dollar index, the bias is bullish. Intraday, we're likely to get a inside bar, which highlights indecision at the channel top. Dips, dollar dips, we look to buy into. Our favoured pair is euro dollar to sell into. Moving away from euro dollar, sterling dollars, especially intraday, is looking quite good. Dollar CAD to buy into. Aussie dollar, not so much. Probably going to keep on consolidating. Dollar yen, again, bought this morning, would still buy on dips. Stock market looks like it's still going to push to the upside. Euro sterling, using correlation, is favoured cross to move to the downside. Euro yen also hit a 161.8% extension level late Friday and has consolidated sidewards today. Probably going to continue that again, that consolidation sidewards. The bias is still bearish, but signals are pretty weak in euro yen, especially with stocks. No clear indication that stocks are going to turn around. Okay, that's our time up. I hope you've enjoyed it. You can register for free at our on our website and get a daily free call. That's normally the favoured currency pair that we see for the day. That trade recommendation will be sent directly to your email box. Okay, best of luck. And it won't be me next week. It'll actually be Steve, my business partner. He'll be hosting the webinar next week. Thank you for attending, and good luck this week. Obviously, helmets on for Wednesday. Okay, thanks very much. Bye now.